Very recently, India celebrated reaching an unprecedented $4 trillion stock market valuation for the first time in history, marking a key milestone for the world's fifth largest equity market as it very quickly narrows the gap with Hong Kong, the fourth largest. This growth is fueled by the growth in the Indian economy, which is expected to surpass both Japan and Germany and become the world's third largest economy in 2027. India will be unstoppable if it manages to pull this off, as it already stands out by its economic growth in a time when it is so hard to find. In this video, we'll talk about how India's stock market grew so much in a really short time, and whether investors will keep flocking to it. Finally, we'll talk about how big it can get and its future outlook. Welcome back to PST Markets. It is a historical moment for India. The country's stock market valuation reached $4 trillion for the first time. Impressively, the market capitalization of the companies listed on India's stock exchanges has increased by a massive $1 trillion in less than 3 years, tripling its value since the 2020 pandemic low and allowing India's stock market to emerge as one of the best in the region as well as in the developing world based on performance. India's key stock benchmarks are currently trading at an all-time high level, having risen more than 13% throughout 2030. They are now heading for their 8th year straight of gains. Meanwhile, Hong Kong's key stock benchmarks have fallen 17%, with the market's total value dropping to less than $4.7 trillion. India's growth is thanks to its robust economy and political stability achieved by the recent victory of Prime Minister Narendra Modi's party in state elections. Earlier this year, India surpassed China and became the world's most populous country, emerging as the fastest-growing major economy. This year, India's economy is expected to expand by 6.3%. This economic growth is very attractive to investors, especially since it stands out against the declining global economy. According to Morgan Stanley, India is set to become the world's third largest economy by 2027, surpassing Japan and Germany. This would be a great feat in the midst of a slowing global economy since India is set to be one of just 3 economies to generate more than $400 billion annually, rising to $500 billion in the years after 2028. Aside from the country's economic growth, foreign investment also increased because of recent circumstances in China. India has been making strong efforts to attract foreign investors to its capital markets, a strategic move in response to foreign investors and companies fleeing China, India's main rival in Asia. China has never been more scary for foreign investors. The country has been struggling with a real estate debt crisis since 2021, which revealed all the hidden problems in the Chinese economy. That was one of the reasons why foreign investors quickly lost faith in China. Additionally, they were discouraged by rising geopolitical tensions between the US and China, which led to a trade war that resulted in economic sanctions and uncompromising Chinese policy that came with raids of foreign firms and detentions of employees. To understand the impact of these issues on China, you should know that the country reported a negative foreign direct investment balance of $11.8 billion in November of this year for the first time since it opened its economy to the world in 1998. China's troubles allowed India to take center stage. As China recorded an $11.8 billion deficit, India had foreign direct investment equal to $9.5 billion, with Singapore and Mauritius being the top sources of investment. The economic slowdown in China is also affecting Hong Kong. Foreign investors leaving China no longer had to use Hong Kong as a gateway to the world's second-largest economy, which rendered Hong Kong's government's efforts to revive its stock market, which included an immigration plan tied to investments and a cut in the stamp duty on stock trades, useless. Additionally, Chinese firms listed on the Hong Kong exchange, such as tech giants Tencent and Alibaba, make up the majority of the turnover on the Hong Kong exchange, leaving Hong Kong at the mercy of China's fortunes. So India was positioning itself as China's replacement, revived inflows of foreign investment. Additionally, investments from retail traders increased. Foreign investment into local stocks reached $15 billion so far this year, while domestic investments have reached more than $20 billion, boosted by a boom in retail trading since the pandemic. Therefore, India is one step closer to achieving its goal of moving from being an economy dependent on consumption, which takes up the largest share of its GDP at around 60%, to an economy led by consumption as well as investment. However, there's one problem with the Indian stock market that some foreign investors just can't get around. It is too expensive. In fact, popular blue-chip stock valuations are sky-high, forcing foreign investors to pick and choose sectors such as autos and technology, while avoiding banks and blue-chip firms. The blue-chip S&P, BSE Sensex, and the Nifty 50 index are both up by more than 8% this year, outperforming the 3% rise in the MSCI. Emerging Markets Stock Index and a flat MSCI Asia ex-Japan Share Index. Since both indexes are reaching record levels, foreign investors, who usually prefer larger companies, found themselves looking for cheaper options. In fact, foreigners pulled $17 billion from India in 2022 because it was deemed too expensive. However, foreign investors made a return this year as China's troubles worsened and India's appeals as an alternative increased. Additionally, their return coincides with a pullback by domestic investors, who drove the market's 150% rise from the pandemic lows in March 2020. Even though domestic investment this year decreased compared to last year's $36 billion, small and medium companies, the segment most domestic retail investors get into, is up by over 28% this year. The decrease is because traditional, safer savings options are now tempting local investors, as bank deposit rates have spiked since the end of 2022. Returns on benchmark 10-year bonds are more than 7%, while one-year bank deposits earn roughly 7%. In other words, equities are becoming more expensive for local investors compared to alternatives that are more conventional and safer. With this in mind, how big can the Indian stock market actually get? So many factors help India. Its economy is growing while the rest of the world struggles, and its population of 1.43 billion people represents a giant pool of potential workers and consumers that companies can tap into, both in India and abroad. Urban middle-class citizens' disposable incomes are constantly increasing, and India can make use of that as more locals invest in stocks, in addition to foreign investors. At the same time, the economy is growing rapidly, which will grow India's stock market. The U.S. Bank forecasts that the total value of shares in India can surpass $10 trillion within a decade. However, while India is helped by the slowdown in China and Hong Kong, it shouldn't completely depend on that, especially since investors have left India before because of how expensive its stock market is. When compared to the U.S. stock market, Indian equities trade at a premium of about 70%, while U.S. peers trade at a premium of around 10%. Other broader emerging markets also trade at 10% premiums. In other words, most Indian stocks are incredibly overvalued. Not everyone believes in India's stock market as a long-term investment. According to Inoj Arora, a chief investment officer of the emerging markets and Asia-Pacific team at JP Morgan Asset Management, Indian equities have traded at similar valuations on 4 occasions in the past 30 years, and each time they resulted in a 5-year period of stagnation. Additionally, foreign investors aren't happy about the capital gains tax of 15% on Indian equities held for less than a year, or 10% for positions held for longer. India also maintains foreign ownership limits on many stocks, which complicates the ability of passive fund managers to construct well-diversified portfolios and of active managers to build positions in their favorite companies. Even though the stocks are overvalued, they are still expected to receive about $1.5 billion from foreign institutional investors this winter. This is due to the increase in India's weightage in the MSCI Standard Index, which is an index for emerging markets. In addition to that, another $3.08 billion is likely to hit the Indian stock market as the U.S. Federal Retirement Thrift Investment Board switches to a new MSCI index, which includes India as its benchmark for its International Stock Index Investment Fund. So investors haven't completely lost faith in India, but they need more incentives to make them stay. Well, that is everything for now. What do you think? Will foreign investors keep flocking to India? And will its stock exchange be able to reach US levels? Please let us know what you think in the comments below. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.